Hey, what's going on, everybody? Hopefully, you're killing it in the markets and you're having fun doing it. My name's Andy. My channel's Finding Value. I'm looking all over the world looking for investment opportunities. I'm sharing it on the channel. If you guys are interested in that stuff, you know what? Just join the channel, click subscribe, give me the thumbs up button. It helps me out. If you guys are making a bunch of money, and hopefully you are, and on the short term, you guys could be losing some money. I get it. I'm down on some of my positions that I created later. But don't get discouraged. The ratios are going to tell us value, and they are saying that we have tons of value in commodities. It's just going to take time for that value to be extracted. So what I do is I cost average in. If I'm down in a position and I see the charts changing to turn back up, I'll add more. So watch my technical analysis videos, see what you guys think. Again, I can't give advice, and that's not what it's meant to be. It's supposed to be financial education so you guys can learn and do this stuff yourself. Now, in this clip, I'm going to talk about price to earnings ratio and long-term interest rates. I talk a lot about interest rates. And the reason I talk a lot about interest rates is because interest rates prices assets. I'm going to say it one more time. Interest rates price assets. And interest rates also rotate money between assets. It basically determines everything. And I'm going to show you the correlation between price to earnings ratios and long-term interest rates. What is the price to earnings ratio? I'll jump in here and get into it. So the PE ratio right here is the share price divided by the earnings per share. It's what multiple are you having to pay for the price of that stock. So if you're buying a stock at a certain price, you're buying that price is given to its earnings. You're paying a multiple for it. In certain market conditions, investors are willing to pay higher multiples than in other market conditions. And the interest rates are what determine those market conditions. So what you're looking at here in the blue line is your price to earnings ratio. It's called the CAPE ratio. It goes from 0 to 50 on this chart in the blue, which is the blue line. Now, on the right-hand side is the long-term interest rate from 0 to 20, and that is the red line for long-term interest rates. And what you're going to see is you're going to see these are correlated, inversely correlated, where one goes up, the other one goes down. Now, it may not be a perfect correlation 100% of the time, but overall, you're going to see an overall trend with an increasing interest rate environment. You're going to see a contraction in the PE ratio, the price to earnings ratio, which means that people are less willing. I'm going to go here. People are less willing to pay a higher multiple in a higher interest rate environment. So they're going to pay less price per earnings given a higher interest rate. And what they call that is people will refer to this as people are less willing to speculate in stocks when you can get a higher interest rate on the bond. They call that a risk-free return on a treasury bond. If you can get a 5, 6, 7% rate on a treasury bond, there's no reason to speculate in stocks. Therefore, the PE ratio contracts and people are selling their stocks and buying bonds. That's really what it means. And you can see this relationship here. Like if you look at 1901, see how the PE ratio was very high and the interest rate was very low? Correlates very well. Now, look what happens to the PE ratio. It contracts at the same time that the interest rates go up. Do you see this correlation here? And obviously, it's not a direct correlation because it came up and down as it was contracting. But the overall big picture view in a rising interest rate environment is lower price to earnings ratios for general stocks, something in an S&P 500 or something in a Dow Jones. Now look at the opposite side. When interest rates were very high and start to go down, stocks want to rocket higher. People move their money into stocks. The PE ratio expands in a declining interest rate environment. And it declined all the way down, and this is a general trend, but this got way out of hand here. It went up far too fast, and it corrected back down. But overall, the general trend was up. Now, in a low interest rate environment, which this could be considered low, sometimes stocks get priced a little bit, they get overpriced. So in 66, stocks were vastly overpriced in relationship to the interest rate environment. We also had very high inflation in the 60s and 70s. So in the 60s, late 60s and 70s, we had a high inflation environment with high interest rates. And you can see that the P/E ratios really turned on it. So another thing here, and I'll draw it in here real quick, is that you'll see general trends. Like you want to do this here real quick. So see this trend here? What happened was you had this general overall trend, and that trend was intact until it was broken. We had an increasing interest rate environment. The trend was going up, and then it broke right here in an increasing interest rate environment. And I'm like, it's game over. The P/E ratios are going to come back down and have to base out for a little bit. And you can see that almost everywhere. We had a breakout here. If you were to draw it like this, and you should be able to see this breakout here. It consolidated the P/E ratio and broke to the upside. And right now, what I see is a declining interest rate environment, which shot this way into bubble land. And right now, the P/E ratio, I think, is at 40. It's all the way back up here. It was pressed and came all the way back up. And when you're up in this bubble land up here, and you're going to have potentially rising interest rate environment, I think you're going to see the P/E ratio contract quite a bit. So I think it's very dangerous to be playing in stocks at the moment if rates were to go up. I mean, they're going to hit hurricane force headwinds if we have large inflation with rising interest rates. Hurricane force winds is going to come right in their face and blow this P/E ratio, I think, to the downside. But remember, in an inflationary environment, their earnings can come back up, and maybe stocks will come down to sideways for a while. They may not just completely crash out, but it's difficult to speculate on that. Now, this is the current valuation here. It is absolutely ludicrous. This is the S&P 500 price to earnings ratio that we're looking at. And what we're looking at is this high bubble area is stocks are in extreme bubble. And down here is stocks are in extreme undervaluation. And it really only hit the extreme undervaluation a few times in history. And that's where you really want to load up on stocks. I mean, that is like perfect. This is where commodities are right now. And they would be valued like down here. But stocks are up above 40. This is extreme bubble land. And it's very dangerous to basically be piling a bunch of money in stocks with the potential for interest rates to go up and that P/E ratio to contract with the interest rate. So that's where I'm getting this information, is basically right here. This is the data behind it and my opinions on it. Now I'm going to do another chart here. This is a scatter plot here, and what it is they put the time frames. This is the 1890 to 1910, the dark blue, but these are just the time frames. And what we're looking at here is this is the 20-year annualized returns in percent. This is -5, 0, 5, 10, 15. The lower the P/E ratio, the next 20-year annualized return, let me just move this here. The next 20-year annualized return is above 10%, or is above 10%. It's 10% or above this area is when P/E ratios are below 10. So if it's below 10, you have a high likelihood for the next 20 years annualized to be above 5% return, because if you look at this big chunk, that's where all these returns are over history, the annualized returns. Now, if you look at the P/E ratio of over 40, which is off this chart, all of these returns on a 20-year annualized returns percentage is below 0 when you get out here. So we're in bubble land. More than likely, you're probably going to see a poor performance in the S&P 500 if the P/E ratio is above 40, which means on this scatter plot where this star is at, that's where it's currently at, is above 40. You're probably going to be like at a below 0. So more than likely, we're going to fall down or move sideways and down. What I think they're going to try to do is inflate, which means that it's going to go sideways but lose value through the currency. That's another way that that you can play this. So the nominal price will stay the same, but the value of the currency drops. So you're actually losing purchasing power value out of stocks, even if it were to go sideways because your dollar is going down. Now here's another scatter plot. This is called the S&P 500 trailing as reported PE versus the 10-year Treasury interest rate. So this one here is the PE ratio versus annualized returns. This one is your index price level and your 10-year Treasury interest rate. And what you can see is the general trend line in this black line here. As interest rates go up, the PE ratio, or the S&P index price level, the index price level goes down. And if we're at like 40 up here, this is the S&P 500 index price level. But if you're at a very high price level and your interest rates goes up, it wants to go back down to the right. So the general trend is as interest rates go up, the S&P 500 index price level goes down. And you can see that in this chart. Should be clear as day, hopefully. So I really wanted to touch on all of these charts so you guys understand how assets are priced and how interest rates have an impact on price. Our interest rates went so low recently, all the way to the downside, that the P ratios, people speculated and went into stocks because there's absolutely no return in bonds. So they were forced to go into riskier assets that blew the PE ratios to the upside. Now here's the problem. If everyone runs into stocks, where's all the money at? It's in stocks, right? Well, if all the money's in stocks, how does it go up more? You're going to need more money, right? It means that the money has been drawn out of bonds and the money has been drawn out of commodities into stocks because everyone's going to be chasing performance. And that goes for institutional investors because they're going to say, how come you're underperforming? And they're going to have to chase performance. Here's the thing. When interest rates go up, it rotates money out of bonds and out of stocks. And if all the money is in stocks, which we've seen on all these big, huge overvaluation valuation metrics, the money's going to go somewhere else. And if this goes to inflation-protected assets, I think it's going to head into commodities and precious metals. This is what I talk about, the big rotation of money and the pricing of interest rates. And what changes the price of interest rates that I'm showing you here and all these valuation metrics and rotations of money is inflation. Inflation is going to force the market into a higher interest rate environment. You've heard me say this if you've been on the channel quite a bit. And I wanted to show you the data behind it. I wanted to show you the scatter plots. I want to show you this direct correlation between interest rates and, on a macro trend, on a big macroeconomic viewpoint, that interest rates affects the pricing of assets. And if interest rates affect the pricing and the PE multiples and everything, it means money's going to rotate out of that and into what we're in. And the valuation metrics, the ratios that I look at, and remember, ratios tell you all relative value. Price to earnings ratio, the CAPE ratio is what it is. All these different ratios that we look at, price to book, price to sales, to evaluate stock valuations. They're all ratios. So this isn't anything new. If you guys are new to the channel, ratios are not new. We use them everywhere. If commodities have never been this cheap, it means the money's not there. And the opportunities, of how cheap this ratio is at, and the rotation of money that could occur when interest rates go higher. And you're talking, listen to the Federal Reserve, listen to Janet Yellen. They're talking about raising rates. You're going to see a massive rotation of money. Now, I know that we're seeing a sell-off in commodities right now. We're seeing some pressure, downward pressure on the short term. This is normal. If you get the big picture right, what's behind me, how all these things rotate and the interest rates move. If you get the big picture right, you use the short-term weakness to continue to accumulate undervalued assets. This is a 5 to 10 year game. You play this game right, you win big. This is not 100, 200%. We're talking thousands of 1,000x increases against the S&P 500, not in real term, not in money terms, against the S&P, which will be declining and our stuff will be going up. So if you get a 10x or a 20x and the stock market goes down 50%, that means it got cut in half. That means you 2x your purchasing power of your 20 or 40x. So if you did a 40x, you did an 80x in relationship to S&P 500 if it went down 50%. You did an 80x. Your purchasing power can purchase 80 times more of the S&P 500. And that's where ratios and that analysis that I'm doing on this channel will kill it for you, because it's relative. It is relative value. And I don't think you guys are understanding that yet. Everyone's pricing things off dollars. I'm pricing asset against asset. I'm making this gigantic move where when I rotate my money from this asset that went up 40x in a dollar value is now 80x in another asset, I can buy 80 times more of that other asset. Insane value has been won in that purchasing power gain. And that's what I hope you guys understand over the long term, because when you really start to understand that, everything else doesn't matter. Price doesn't matter. Price is just a function of executing the value. It's just a realization of value. Now, value, it may take some time to do this. It's not going to be 1 year or 2 years. But the thing that gets me even more excited is that commodities are some of the most volatile assets in the world. And what a tech company might do, you might see a 800% or 1,000% gain in a tech company over 10 years. A commodity company can do it in a couple years. It's that much faster, but you're going to have to ride through volatility. You're going to have to see some of these positions go down 20, 30%, or even 50%. You have to ride through it. You have to know this value. You have to know what I just taught here. You have to know the interest rates affects the environment. And if it affects the environment, it rotates money. And if it rotates money, you better be in the undervalued asset where that money's rotating into. If you can figure that out, guys, you've just won as an investor. If you guys like this content, give me a thumbs up. Appreciate you guys listening. This is Finding Value.